Hello, and welcome to a very special edition of South King County Real Estate Update. This is more of like, we'll touch on a little bit of local stuff, but mainly this is going to be kind of a national show, an overall show of what is happening in the real estate market and why we're starting to see so many headlines about a housing market crash or a bubble that's going to burst. I apologize for the delayed start here. I'm having some technical difficulties, so I'm using my phone audio. So if the audio quality is a little bit off, I truly apologize. I was trying to troubleshoot the problem, but it's just not working. So I will go ahead and jump into it. Share. Is the housing bubble about to burst? I honestly, I've heard this question or seen headlines alluding to a housing market crash or a bubble bursting. And I thought it was just super important to address this issue head on. So let me go ahead and jump into it. These are some of the headlines. Whole world's in a housing bubble now. Get ready for the crash. All of these, they're very sensationalized headlines, as you can see. And if you actually go in and read some of these articles, a lot of them don't agree that the housing market's going to crash. It's just kind of clickbait. But when you have a void of information, emotion tends to drive decision making. This is from Mark Hackett, chief economist, or the chief of investment research at Nationwide. And this is kind of true. If you don't have any facts to base decisions on, you kind of got to go with your gut, and your emotions play such a huge role in that. So this is a lot of the people that are really terrified of what's going to happen. They just have a lack of knowledge about the stats, and they remember 2006, 7, 8, and they're like, oh no, here we go again. But we're going to get into that and let you know, why are people concerned about a crash? So I've talked in previous shows about buyer fatigue. It's just been such an insane market this year for buyers. There have been very few homes on the market and a lot of competition for those homes. I know people that have put in 10, 12 offers on a home and haven't gotten it. We've, in February, March, it was pretty much all anyone could talk about is how do you get your clients' offers accepted when there's, 30 others sitting in a stack on the seller's table going, which one? So 29 people in that situation were quite unhappy with the decision. So there's a high median price point. Homes are appreciating at a crazy rate. Low inventory. Homes are selling for high over list price. And they're not lasting long. Sometimes it's only a day or two on the market for the hottest homes, and they're gone. And it's such a quick turnover. Mainly the buyer demand is driven by low mortgage rates, and this is from a couple months ago, but half the houses listed in April went pending in less than 1 week, and 19% of homes sold in April had appraised value come in below the contract price. So the buyer was willing to pay more for the home than the bank was willing to lend on it. And there has been a slight drop in showing traffic the last few months. It's been, just really kind of uncharacteristic for this time of year to tick down this much during this time period. But also remember that people have been stuck inside for over a year now and unable to travel. And all of a sudden it's summer, some travel restrictions are lightening, and people are taking off. They're doing things. And but if they were shopping for a home in March, right now, with the buyer fatigue and just being frustrated and wanting to go see the world, they're spending a little less time looking at homes and a little more time out in the world. So buyer demand does remain healthy. Showing traffic is still above last year's levels, even though we're seeing that quick little month-to-month drop. So this is likely to cause an increase in inventory levels in the coming months, because if there's fewer people buying homes, then there will be more homes on the market, and ease upward pressure on the real estate prices. So the more homes that come on the market and the less demand there is for them, prices will drop. Simple supply and demand economics. Home values, as I said, are rising at a pretty crazy pace. But if you look at these are year-over-year comparisons. So January 2020, that was pre-pandemic. So comparing that to this, that's comparing pre-pandemic to post-pandemic. And the pandemic, really, home meant so much more to people during the pandemic or after the start of the pandemic than it did before. They realized they're spending a lot more time at their homes, they're working, their kids are studying, and home is just that hub. And people are spending more time at home. So this is kind of a comparison of, I think January is the perfect year-over-year comparison to show pre-pandemic versus post-pandemic. And then these other, from March, April, May, this is when the pandemic was hitting last year, and home prices kind of dropped for the first month or so of the pandemic. People were so uncertain, and making a move is a big decision. People don't make big decisions when they're uncertain about the future usually. So you can see that March, April, 11, 13% increase year over year. But remember, March, April, we had a big drop in values last year. So that accounts for the big increases in here in March, April, May. So year over year comparison is, yes, it is 15.4% higher on prices than it was last May, but May was just the beginning of the recovery of the shock of, pandemic happening. So more listings are coming to the market. You can see that throughout the year, each month, we have had more listings come to the market than the month before. And this is generally what we would expect to see trend-wise in a normal year. So here's just a couple quotes for you. It looks like existing inventory is starting to inch up, which is good news for the housing market, parched for more supply. We're seeing another significant week-over-week gain in inventory, great news for buyers. And supply is expected to improve, which will give buyers more options to help tamp down the record high asking prices for existing homes. So this is just saying, as more supply becomes available, buyers won't be competing as intensely over the same homes, and the values will start to tamp down just a little bit instead of, bidding 100K over like they were a couple months ago. Another fear is forbearance and foreclosures. Forbearance is coming to an end. And a lot of people believe that that's going to lead to just a flood of foreclosures. So comparing this to the recession, 2006, 7, 8, there are fewer home buyers in trouble this time. During the last housing crash, by the end of it, 9.3 million households had lost their home to foreclosure, short sale, or because they simply gave it back to the bank. That's definitely not happening. Last year, when the pandemic was first starting, stay-at-home orders were just issued. It was projected that up to 30% of all mortgage holders would enter the forbearance program, and only 8.5% did. So that is a pretty huge difference between what was expected and what actually happened. And now we're down to 3.5% of people with mortgages in the forbearance program. So if everybody that was still in the forbearance program went into foreclosure, we would have 1.8 million foreclosures, which is nowhere near the 9.3 million that we had back in 2008. So, and I don't want to downplay this. The people going through foreclosure, that's a crisis to them for sure. I don't wish that on anyone, but if our worst case scenario, and the projected numbers are significantly lower, worst case scenario is 1.8 million. That's still like, an eighth of where we were 2008. Number two is most of the 1.86 million in forbearance have enough equity to sell their home. So if 87% of those in forbearance have over 10% equity in their home. So if worse comes to worse and they can't come back from that forbearance, they can sell and either break even or make a little profit and move on from there. So of the 13% that aren't able to sell because they don't have that 10% equity in their home, if those 13% went into foreclosure, there would be 241,800 mortgages that went into foreclosure, which is less than we had in 2017, 2018, and 2019. So year over year, I think, like, comparing it to other years, it's not like an explosion of foreclosures. These are probably, in a lot of cases, the people that might have been foreclosed on regardless. And third, the current market can absorb any listings coming onto the market. As I said before, buyer demand is so high. And in 2008, there was a 9-month supply of listings. So that is a crazy strong buyer's market. Anything over about 4 months, 3 to 4 months, is a seller's market. Anything over that is a buyer's market. Anything less than that is a seller's market. And currently here in Southeast King County, we're at 0.5 months inventory, like 18 times smaller than the 9-month supply of listings back in 2008. And Lawrence Yun, the chief economist of National Association of Realtors, said any foreclosure increases will likely be quickly absorbed by the market. It will not lead to any price declines. Also, those in power will do whatever is necessary to prevent a wave of foreclosures. We've seen this with different bills and things that have been passed in the last year to, ease the stress of the pandemic on households. So now that the forbearance is going away and the eviction moratoriums are being lifted, there's a whole bunch of ideas explained in this fact sheet that is helping those people stay in their homes that are right on the edge and kind of struggling. So there are plans in place to help people who are in need. And American home equity has skyrocketed. So the average gain in equity over the past year was $33,400, and that's nationwide in Seattle, in Seattle area, King County, Pierce County. It's generally more. the current average equity of the mortgaged homes is $216,000. So the average of equity nationwide that people have in their homes is $216,000. 38.2% of homes are owned free and clear. So these ones don't even have a mortgage. So almost 40% of homes in our nation don't have a mortgage. So they can't be foreclosed on if they don't have a mortgage. And 19.6% increase in equity, totaling 1.9 trillion. So people have almost 20% more equity in their homes on average than they did a year ago. So is the housing bubble coming? Risky loans. Let's talk about those first. So this is the chief economist for CoreLogic. This quote says, "There's a marked difference in today's run-up in prices compared to 2005, which was a bubble fueled and risky loan and a bubble fueled by risky loans and lenient underwriting. Today, loans with high-risk features are absent, and mortgage underwriting is prudent," which you'll see here in 2006. There was $376 billion in loans, mortgage loans given out to people with a FICO score of less than 620. Now, in the last year, in 2020, it was only 74 billion. So the restrictions on lending have tightened up. You do have to have a good credit score to get a decent rate. And it's just, the restrictions are in place, so it's way harder to get a loan, especially if you can't actually afford it. These outsized increases have raised concern that a home price bubble is emerging. However, conditions today are quite different than in the early 2000s, particularly in terms of credit availability. The current climb in house prices instead reflects strong demand amid tight supply, helped along by record low interest rates. And this is out of Harvard. So you can see from the historic data for the Mortgage Credit Availability Index, this is how easy it is to get a loan. And you can see in 2006, you basically just had to have a pulse and they'd give you a loan. It was all self-stated income, no proof of anything. So you said, I can pay this much. And the bank said, okay, and give you the loan. Now with the stricter guidelines, you can see the quick fall in 2008 where the restrictions all came into place. And we are staying right down in that lower range here. It's much, much harder to get a loan now than it was in 2006. So this is another reason that it's not a bubble, because the loans that they're making are actually, solid loans. As far as mortgage debt, so monthly mortgage payment is increasing significantly. So you can see that the overall monthly mortgage payment is up quite a bit. But there's been a lot of people that have moved up this year in the real estate industry. Like, if they were in a condo, maybe they moved to a house. If they're in a small house, maybe they moved to a bigger house because the pandemic just made them want more room. More rooms. People wanted the Zoom room. So, overall, mortgage payments are going up. And this is a headline you'll probably see, and it is true, but the home's worth so much more now that they are moving to larger spaces and willing to spend so much more for a comfortable space that they can hang out in. Hopefully they don't have to quarantine in there. Hopefully that part will be kind of over for a bit, but you never know what happens in the future. This happened once, it could happen again. So you never know when you're going to be suddenly stuck in your home. But this is what you really need to look at, not the actual mortgage payment. It's the household debt service ratio for mortgages as a percentage of disposable personal income. So basically, in the housing bubble, people were paying up to 7.21% of their disposable, for the household debt service ratio. And now it's down to 3.45%. So this means that people have a lot more money to spend now, and they're spending less of a percentage of it on mortgage. For home equity, one of the big things that really drove the bubble back in 2007, 6, 7, 8 was home equity cash out by refinance in billions. This is home equity cash out by refinance in billions. Those home equity refinance, cash out refinances went crazy in 2005, 6, 7. People were just, their homes had gone up in value so much, they're like, well, let's refinance and buy that jet ski and go on that trip. And we're really just financing lifestyle and using their homes kind of like an ATM. Whereas now, you could see a little bit of a jump in 2020, which I think did scare some people, but there was a lot of people struggling in 2020, and interest rates were so insanely great. We had 16 record lows throughout 2020. So as the further in the year we got, the better interest rates looked. And a lot of people just decided to take advantage of that, say, hey, well, since I'm temporarily laid off from my job and the interest rates are so good, let's cushion our living a little bit by doing this cash out refinance so we can be a little bit more comfortable through the rest of the pandemic. But yeah, basically interest rates were so great that if you owe on your house and you didn't refinance them, maybe you should look into it. And the tappable equity of the U.S. mortgage holders is surging. So with values increasing so significantly, we had with home values increasing so significantly, people have a lot more equity in their homes. So there's more tappable equity in their homes than ever before. Like, look how, so this is like the available credit. If they wanted to do a cash out refinance, they could take a lot of cash out, right, on average. So as far as affordability, looking back at the bubble years, house prices exceeded house buying power in 2006 nationally, but today house buying power is nearly twice as high as the median sale price nationally. Many find it hard to believe, but housing is actually undervalued in most markets, and the gap between house buying power and sale prices indicates there's room for further house price growth in months to come. And this is from Mark Fleming, the first American chief economist. So there is a lot of people out there with money that they could spend on housing, and like I said, the personal value of home means so much more to people now than it did a year and a half ago. And people are willing to spend more for that. As far as the Housing Affordability Index, you can see this. So this chart is a comparison of income, mortgage rates, and home prices. So back in 2009, 10, 11, things were basically, there was a lot of distressed properties on the market. There was an oversupply, and so home values plummeted. And so it was a lot easier to buy a home back then if you had money compared to the home prices now. So, but now you can see with the improvement in mortgage rates over the past couple of years, even with the crazy influx in prices, it is significantly it's like still pretty easy to purchase a home based on those metrics. However, affordability does continue to decrease. So you can see it went up in 2020, the affordability, it became more affordable. And now we've had a little bit of a decrease based mainly on housing prices escalating so quickly. Incomes are not keeping up. And as far as supply and demand, the main driver of the housing shortfall has been the long-term decline in the construction of single-family homes. And if we look at this chart here, you can see leading up to the recession, we had been overbuilding homes for many years. And there was an oversupply. We had too many homes. We had more than we needed. So now we have had 13 straight years below the 50-year average for building. And this is kind of driving our lack of supply. Yeah, it's actual like lack of supply. There's not been houses built for a while. And then with the construction costs going up so much in the last year, that's definitely slowed building down more than it would have been otherwise. Like if the cost had remained the same since 2019, I think we'd see a lot more building right now, but lumber and materials have gone up so in price so much, it's hard to build as many homes. But bringing us back to Lawrence Yun, with the chief economist at NAR, he says, it is not a bubble, it is simply a lack of supply. So if you have any questions, please feel free to reach out. My phone number and email address are on the screen there. I would love to have a chat with you. If you have any other questions or concerns about the housing market, I would love to just have a conversation, address those, and put those fears to rest, because people make better decisions when they're well informed. So thank you so much for joining me for the Housing Bubble Headline Special. I will be back here at 3 p.m. on Friday for a regular edition of South King County Real Estate Update. Thank you so much for joining me, and have a great day.